It's really hard to build an index in crypto at the moment, and it's been this way probably since around the end of 2024, where you get a better risk-adjusted return than just investing in Bitcoin. And part of that reason is because obviously the weight of influx of tokens coming into the market has really fragmented capital, and there's been this kind of slow bleed for a large section of the market and really not great performance. A lot of investors, they come into crypto and they start with Bitcoin, which is quite unusual when you think about traditional markets. You wouldn't have 90% of the market starting in something like Nvidia and then going to an index. In crypto, you come from Bitcoin. And so anything that you are then moving into, or any product that you are offering to that market, has to be better than Bitcoin. And at the moment, a lot of these indexes, including some of the ones that you will build on our platform, and this is part of how we're thinking about the next evolution, is you ultimately get more risk for less return. So I think that's one of the big challenges of indexing at the moment in crypto.
If we think of crypto getting a Vanguard type of moment, what do you think needs to happen in this space? Is it about, the entire market cap growing? Is it about regulation? Is it more institutional adoption? What is it? Hello and welcome to Conversations and Insights. Today we are tackling a question that is really at the heart of both institutional and retail investing for the new asset class, cryptocurrencies. And the big question is, can crypto be indexed? Indexing is something that has really conquered traditional asset classes, be it equities, bonds, commodities. We have 50 years that it has really dominated both institutional and retail investing. And the reason is simple, right? It's diversification, it's low cost, it's a systematic way to gain exposure to different subclasses of financial products. But crypto is different. So we'll be talking about that. What are the challenges and the opportunities? And how will it look like when it happens? We are seeing a build out of institutional infrastructure, ETFs, and we're seeing some indices. We're seeing do-it-yourself tools. Who wins this war? What happens? And to help me unpack all this, I'm joined by a good friend, Jessica Eler. Welcome, Jessica. Thank you for joining us from New Zealand.
Thank you, Efi. It's great to be here.
And just so everybody knows, this is a wonderful moment. We were colleagues at Daily Fintech. That was a decade ago when Fintech was really very different and much more contained and concentrated. Jessica was one of the sharpest voices covering Fintech out of Australia. At the time, you were at Tyro. Then you went on to co-found Zuber, a wealth tech, right? A disruptor that was acquired in 2019. And now you've moved to co-found another wealth tech, the Melia, which is a Greek word that I absolutely love. It's a beautiful name. It means foundation, the Melia in Greek. And it's all about crypto indexing infrastructure. So you're the best person to talk about our topic. And let's start with the basics. Really, when you started your journey into indexing infrastructure for crypto, what were the first things that sort of hit you that, hey, this is completely different asset class than traditional assets, and it doesn't translate as maybe we all thought?
Yeah, that's a great introduction. Thanks, Efi. I think a lot of the points that you talked about in your introduction about why indexing is so powerful and makes a lot of sense to people were some of the same reasons we were thinking about when we were starting to look at crypto sort of 3 or 4 years ago, and sort of realized, if you're coming to this space new for the first time and you don't want to spend a lot of time researching individual tokens, buying an index just makes so much sense, right? Because you can often get exposure to a particular segment or sector that you care about. And you've probably done that really successfully in equities markets, and you've seen great success with that in your own sort of investment portfolio. And so conceptually, when you look at crypto, the problem is even more profound because you have so many more tokens and you have equities to index that it just seems to make sense that this concept should apply really naturally.
How many do we have right now? Where are we
Well,
at?
this is it's very debatable. Last time I checked a few months ago, there were reports of 50 million. I would say it's well north of that now. And, for those of you that are sort of listening that know a little bit about crypto, you know that there's really no barrier to entry to creating a token. Anyone can spin one up, from their bedroom or office or wherever you are in the world. So I think that's actually one of the dynamics that makes indexing quite different in crypto, is that rather than, say, in traditional markets where the investable or indexing universe is the companies that have typically made it through the valley of death in startup land, and they've made it to sort of being IPO'd and listed, and now they've been included in professional indexes. In crypto, to sort of sort out, what are the really great things from maybe the not so great things is a lot harder, because typically you're dealing with a market that's almost entirely made up of startups. Like a lot of these projects haven't achieved product market fit yet. Some of them have no product at all, or a vaporware or a scams, and intermingled in there are some really great projects. So I think, getting back to your question, what were some of the assumptions we had? We had the assumption that indexing could be really powerful in this market for people that didn't want to spend a lot of time researching and want an exposure. But then the fundamentals of what you were actually indexing, which is a universe of what we would call startups, meant that the really high failure rate in that universe made that failure rate bleed through into any index that you then constructed. So the big lesson, I think, from the first iteration of our product build was, if you're going to index, you need a very, very strong, powerful filter on what you let into that index.
Interesting. And as you said, there are whatever 50 million tokens out there, and they're scams. So a big challenge is the screening. So the first thing is it becomes about constructing a filter, right?
Yes.
To do that. And what is the filter? I imagine has liquidity as maybe the first sort of item, or what is it? Is it listing on exchanges? What are the factors that you sort of have to consider for this screening?
Yes. Yeah. So the way that we look at that 50 million token challenge is we whittle that down as sort of a primary filter by what has a minimum market cap of at least $1 million and what has daily traded volume of $100,000. So trying to really get to what at first pass is investable to some degree. Now, not everyone will be happy with that level of filtering. A lot of people might want to increase the liquidity thresholds, or they may want to increase the market cap threshold. So rather than us determine what those secondary thresholds should be, what our application does from an indexing building perspective is we apply that first primary screen, and then a user comes in and sets additional filters. So they might be looking to construct an index that is, tokens between 50 million and 100 million market cap. They can then set those parameters in the tool if that suits their investment sort of philosophy or thesis.
Yeah, understood. And what about the data integrity, the data quality? I mean, we talk across all assets now about data quality because of AI, because it's foundational, right? And if you want to apply AI on, investing, whether it's stock picking or any type of investment strategy, data quality is a big issue. And here in this asset class, I mean, we all know that there's wash trading. Do we trust the exchanges? How do you clean the data? Are there, institutional providers that are cleaning this data for you? What's the situation with the data quality even after you've filtered, even for blue chips like Bitcoin and Ether and Solana?
Yeah. This was a big consideration actually when we were building the platform. And the first, I think, kind of design choice that we made was to have multiple high quality data feeds from what we would consider institutional grade data providers. And so those data providers are, for the most part, dealing with some of those issues. So dealing with minimizing wash trading, excluding exchanges that they believe are unreliable. And we know in crypto that there are a plethora of different exchanges and not all of them are maybe producing the highest quality data. But from a, I guess, data integrity and also redundancy perspective, there was a lot of value in thinking about building out our engine to ingest multiple data feeds and then actually averaging some of those values that we were receiving, such as price. But during that sort of cleansing process, we're also looking for price outliers and dealing with those. You will get the sort of odd random spike in crypto. It's not as clean a feed as maybe what you might expect in the equities market. But that's proven like a structural choice that's made a lot of sense for us now that we're up and running and live. And the idea is to just continuously add more of these high grade data providers over time and just increase the, I guess, the perception, but also the reliability of that data that we're allowing users to construct indexes from.
And Jessica, I assume this is a mix of SEX and DEX data, right?
Correct. So those aggregators are sourcing that SEX and DEX data. When you're in our platform, however, you can then just choose to say, well, I'm only interested in tokens from a particular exchange. So you can then add an additional filter into what you're looking at.
Okay, so you can say I want from Uniswap and Coinbase, like,
Yes.
Something like that, right?
Correct.
What other operational realities or uniqueness are you facing in this process? I mean, obviously, these are markets that are trading 24/7. What else? What other particularities are there that make it tricky and different than, equities and bonds and gold and so on?
Yeah, well, I think you hit the nail on the head there. They're 24/7 markets, and that does change a lot of how you need to think about index construction. So, one of the important things we had to think about is how do we manage rebalancing in real time? Because we don't have the ability to sort of manage that process during a close period, which is typically what I, believe a lot of the existing sort of more traditional index providers would do. So that had some impacts on the way that we structured the underlying index calculation. I think as well, one of the things we provide in our platform is you're obviously coming in, you might have a thesis, you start to play with the filters and you construct an index alongside letting you build a cap weighted index, which is typically where a lot of the larger indice providers in crypto have gone. We also allow you to construct equal weight indexes. But in the cap weight case, it was quite interesting because we had to think about how to sort of separate the change in price based on change in circulating supply. So one of the things that happens a lot in crypto is that new tokens are issued or minted or released. That's part of the sort of, framework of how a lot of crypto projects operate. So we had to make sure.
Or burnt, right? Burning.
Yes, exactly,
Burning.
or burn. So we had to make sure that we weren't attributing any false changes in price based on a change in circulating supply, whether that was new tokens added or tokens removed. So that was another operational reality I think we had to deal with. And then you've got the other ones, which I think you're probably familiar with. So you will have forks of a token and the old token will remain, often still being traded, but a new token will appear. How do you think about that? And then delistings as well. And so that means if something falls under those initial thresholds that I talked about earlier, that market cap and daily traded volume will remove them from the platform.
Yeah. Jess, you mentioned that there are, we are more familiar with the ETF products
Yes.
on crypto, and we've had a flood of those, but they are indexed to a single crypto, right? Be it Bitcoin, Ether, Solana, whatever, right? But there are indexing products from providers like CoinDesk. I think NASDAQ has that there's benchmark providers there. And these products, from what I understand, they are very small in terms of the total size, right? If we compare it to the market. Can you tell us a little bit about how these products look? Are they more cap weighted? Is there any characteristic that we should be aware of? I looked at some numbers, and really the assets under management are small, and it seems that they are indices that have 70% Bitcoin or something like that.
Yes.
Tell us a little bit about that and the do-it-yourself indexing interest, and what you're seeing. Is this more sophisticated users? Yeah.
Mm. Yeah, I think, it kind of going back to that point made earlier, indexing makes a lot of sense in this space. So many tokens, let's whittle it down to, say, the top 10 or a particular thematic, maybe layer one network tokens. I think where some of the challenges have arisen, and we've faced the same challenge ourselves, so I imagine a lot of the other platforms and providers in the market face it too, which is that it's really hard to build an index in crypto at the moment. And it's been this way probably since around the end of 2024, where you get a better risk-adjusted return than just investing in Bitcoin. And part of that reason is because obviously the weight of influx of tokens coming into the market has really fragmented capital. And there's been this kind of slow bleed for a large section of the market, and really not great performance. And Bitcoin, despite obviously the sort of market, we've seen in the past few months, has remained the premier asset. So a lot of investors start with Bitcoin. They come into crypto and they start with Bitcoin, which is quite unusual when you think about traditional markets. You wouldn't have 90% of the market starting in something like Nvidia and then going to an index. People come often with lots of different, asset exposure experience. In crypto, you come from Bitcoin. And so anything that you are then moving into, or any product that you are offering to that market, has to be better than Bitcoin. And at the moment, a lot of these indexes, including some of the ones that you will build on our platform, and this is part of how we're thinking about the next evolution, is you ultimately get more risk for less return. So I think that's one of the big challenges of indexing at the moment in crypto.
Yeah. Is there, if we think of crypto getting a Vanguard type of moment, right? What do you think needs to happen in this space? Is it about, the entire market cap growing? Is it about regulation? Is it, I don't know, more institutional adoption? What is it that you think could bring the Vanguard moment?
I think it definitely needs to happen. I think it will happen. I think it's some way off happening. And I think a big part of that is building an index that ultimately delivers you a better risk-adjusted return and still challenging. So I think when investors go into indexing in traditional markets or in any space, they're sort of saying, well, I'm willing to sacrifice a little bit of the return I might get from the top asset for taking less risk overall. And that's kind of the intent behind an index. You're getting the power of that diversification baked into the product that you're buying. And that's worked really, really well in equities. And there is an assumption, and I think this was an assumption we sort of proved was wrong, was that you could lift and shift that concept into crypto. But of course, it's very different. You have a very different set of dynamics going on in crypto. And what you actually have, back to my earlier point, is this pool of projects that are effectively startups. So rather than thinking like a traditional index investor where you're investing in blue chip, stocks or a particular thematic that's just absolutely taking off, but, in reputable listed companies, in crypto, you almost have to think more like a venture investor. You have to walk into crypto. If you're looking outside of Bitcoin or outside of, say, even the top 10, you have to think that most of the projects you invest in are probably going to fail. And so that's where that filter becomes really, really important. How do venture investors do that? Well, they spend a lot of time looking for the absolute best startups that they can invest in. They invest a huge amount of research and effort trying to identify those startups. Every startup that they put in their portfolio, they believe could be the unicorn. They don't invest in something they don't believe could be a unicorn. But ultimately, they know there are still so many unknowns that come 5, 10 years down the track when they come to crystallize those returns. 9 out of 10 or 8 out of 10 of those startups will have failed. And I think that's an analogy I often use to help investors think about crypto, because the average investor, now that they're seeing crypto become a lot more embedded into mainstream thinking, they're seeing companies like BlackRock talk about it. They're seeing it get on the radar of some financial advisors, and you've got products now available. There is, and I think sometimes a slight misconception that the space has matured to the point that it is in the same realm as, say, equities investing. But I think, as you can see when you look at a lot of our charts, and as you can see from just what's happening in the space right now, that's not really the case. So that doesn't mean that Vanguard moment won't happen. I mean, we need to move towards systematic rules-based exposure to the market, but I think there's still a huge opportunity in this space for bringing together expertise and insights from people that really understand what's going on, that have great sense of token selection and market allocation and timing, and using their insights along with rules-based and systematic insights to construct indexes. So that's sort of where, just to give you a bit of a flavor of how we're thinking about where indexing needs to evolve to for crypto.
So a combination of fundamental analysis, if you want, along with the rules-based approach of indexing overall, some combination of that.
Yeah, because there's still such an information asymmetry in cryptocurrencies. I think when you look at the equities market, so much data is standardized, and so much data is clean, to your point. And there are rules and there are regulations. Crypto doesn't live
An analyst.
Exactly right. Crypto doesn't really live in a landscape that's matured to the point that it's relatively stable. All of those things are in flux in crypto. And so for you to really construct an index that gives you that outperformance, that allows you to build and filter for what's really worth investing in, you need a combination of both. And those people exist. So they don't exist in the traditional way we think about them. They're probably not, working at some of the top tier institutional managers, but those pools of deep insights, I absolutely exist, and there are people doing very well in crypto right now, and the market needs to find a way to bring those two groups together, I think, if it is to evolve and make it more investable.
So it's, as you said, like in the startup world, the intelligence is there, but it's scattered, and there isn't a platform to access that intelligence, whether you want to think of it as crowdsourcing, and ranking that intelligence, but that's really what is happening. I'm seeing from here in Switzerland, where the market is also mature with actively managed certificates for more sophisticated or so-called qualified investors, right? This is not retail because of the minimums and the regulations. And I see that most of them employ strategies that end up either being long short, not outright long, right? Or long and cash as in stable coins, right? The typical hedge fund strategies, if you want, that we see in the classic world, which is different than indexing, for sure.
Yeah. Well, you raise a really interesting point there, and it's something we have explored on our platform. So along with coming in, say, Efi, you could come in and you might have a thesis and you could construct your own index, but it does rely on you knowing a little bit about how you want to construct that. You have to have a little bit of insight to use the tool. If you're, say, someone that doesn't really have that insight but would like to leverage someone else's insights, we have a feature on our platform for analysts. So if you're an analyst and you come in and you have an idea and you construct a basket, you can then expose that to other people coming in the platform that don't want to do that work. But one of the really interesting strategies that one of our analysts has put together is exactly what you mentioned, a long short index pair. So it goes long the premier asset, so that's been Bitcoin and arguably still is, and it goes short a basket of aging tokens. So tokens that are between 2 and 3 years old with sort of $100 million market cap minimum. So that's the threshold. So you know they're relatively investable. And going long short that index pair, rather than being down sort of 25%, just if you were long Bitcoin in the last 90 days, you'd be up 6% in that strategy. And so that's a relatively sophisticated strategy for the average person. That's something that you probably can't really sell to a mum and dad investor so well, but there's real ability to package some of those types of things up and real opportunity for that type of strategy in crypto because of the market dynamics. And I think, probably not everyone's really tuned into that, but it's not until you actually start to segment the market from an index lens that some of these opportunities actually become visible.
Yeah, it's as you said, we're early in this play. It's clearly going to happen. And actually, when I think of cryptocurrencies, they're probably closer to commodities rather than equities. And if we look at the indexing in commodities, again, the constituents have been traded for hundreds of years. So there's familiarity with, what their utility is, how they function, custody, all the issues. Whereas here, we don't understand yet the differences, and there's a whole universe and what the narrative or the utility of each of them is, right? They're still sort of, it's evolving, it's changing.
Yeah, that's spot on. And it is evolving at a pace that has never been seen before in other markets. I think we're right at this relatively embryonic stage of the development of the asset class. And that was another thing that I think played into, something different or a different lens you have to have on indexing. In traditional markets, indexing is a fairly static idea. I have this basket and it probably doesn't change too much because, there isn't a huge rate of influx of new companies being listed and IPO'd. So the change, the number of times I have to really change what's going on in my index isn't really that frequent. I'm probably okay to meet every 3 months or every quarter. Half a year as an investment committee. In crypto, the world can change overnight. What you set, what was eligible for the rules of your index yesterday, 20% of that might not be eligible the day after. So how do you manage that in a traditional index approach management process? It's really, really challenging. So I think rules-based indexing that's automated, that's managed by a platform that can execute on those changes, and then you can have that execute immediately in your custodial platform of choice, means that actually custom indexes may have a bigger role to play in crypto than they ever have had a role to play in traditional markets. And purely from the fact that crypto moves so fast, your index needs to move just as fast to reflect that. You don't want to be sitting there waiting for an investment committee to meet in 3 months, because that could have destroyed a lot of value in your portfolio if you hadn't sort of rebalanced or, managed that appropriately.
Interesting. This is really the distilled wisdom, if you want, from the learning from the Melia, that yes, the Melia, yes, foundations, but here we're learning to build the customizable indices, that maybe this is where AI can help in building these, and the traditional markets can learn from this and maybe take advantage of this, because this is a different breed. So maybe the Vanguard moment is the wrong term to sort of have as a North Star. Maybe the North Star is something more dynamic than the Vanguard moment, and yet we are talking about a diversified exposure, a low cost exposure, but dynamic.
Yes, I think that's a really interesting point to make. Agentic finance is just emerging, right? That's going to be huge. And if you think about how powerful agentic finance can be in crypto, it's quite profound, because the amount of research that you need to do already feels overwhelming in crypto to be able to get across what's happening, and all of these different forums and all of these different new technologies. Really, you need AI agents to be able to do a lot of the heavy lifting for that work for you, and they're probably very well placed. And we have seen some platforms that are starting to use large language models to do some of that work and develop investment portfolios. They're still relatively rudimentary, but I think we will see that certainly continue to emerge. And it's something we think about a lot. Agents could certainly be analysts on our platform. So how do you build a platform that caters for, humans that want to come in and build a custom index, but also agents of humans or autonomous agents? How do they come in and bring their insights to the table from the research they've done? So it's a very interesting area to explore.
Yeah, I was going to ask you in closing what you're excited about in this space. You're in wealth tech, but you're in the cryptocurrencies space of wealth tech. You're more in the do it yourself, but also it's not only retail, it's also institutional investors. What is energizing you about this year? Is it agentic finance? Is it this customization, personalization? What is it exactly?
Yeah, definitely agentic finance is a very energizing, area to explore. I think ironically, what energizes me is the insight that we've developed building the platform and doing the work that, it is really, really hard to get better returns in crypto from indexes. So typically, as I mentioned, you're taking more risk for less return. That can sound like a negative, but actually what it pushes you to then do is go, well, how do I improve this? How do I make this better? Because ultimately, the mass market do want an index product, and index products do make sense for that market, and they want structured, packaged exposure. So I think having arrived at that insight and then being able to build from there is really exciting, because now we can bring in those different, analyst-led insights, agent-led insights, along with the rules-based process, and build something that really does reach that mass market audience and is powerful enough to give them a great return. Because I think there is a risk that a lot of people will pile into crypto in the next sort of 12 months, and maybe they'll do really well because we're obviously come down from such a large price reduction. But it's really important that people find ways to invest in the market sustainably, and I think that has been one of the things that's kept a lot of people on the sidelines.
Interesting. Jessica, thank you so much for these insights. Very, very refreshing and very topical now. As you said, the market has been shaken out and doesn't understand why this has happened. There's always stories, aftermath that we can tell ourselves, but it's definitely in the spotlight how to invest in this space without taking these huge risks of drawdowns, basically, and how to gain exposure to the asset class versus just the top 2 or 3 tokens.
Thank you, Efi. It's been a great chat.